All right, guys, I'm going to talk to you about the Federal Reserve System. And this is probably one of the more difficult concepts, or some of the Federal Reserve System is one of the more difficult concepts to understand. And kids sometimes will struggle with some of the not functions, but how we regulate the money supply. So we'll kind of go through here and talk about some of this. But the Federal Reserve, guys, that is a nation's bank. That is a bank that our banks actually bank with. And a lot of us obviously don't realize that our banks have banks that they deal with, and obviously they do. So let's go through some of the basics of the Federal Reserve System. You see there was formed in 1913, and guys, up to 1913, there was a lot of banking instability. And when that occurred, there was nowhere for the banks to turn to. And so you had people like J.P. Morgan and some of the wealthy people, philanthropists of that time period, would have to bail the banks out with their own money. People in the oil business and steel business, things like that. And so in 1913, they developed the Federal Reserve System there, in which was a place where our banks could then turn to borrow money, things like that. So it was a key thing that happened, obviously, many, many years ago, and obviously still around today. So going on, today's Federal Reserve Chairman is Jerome Powell there. It does change. It used to be Janet Yellen, and again, it changes from years to years. Ben Bernanke used to be Janet Yellen, now Jerome Powell. So they it does change. But structure of the Fed, you'll see this on the worksheet, the notes outline that you're doing here. You see the Federal Open Market Committee, Board of Governors there, Reserve Banks, all this stuff I'm fixing to talk about as we go through this PowerPoint. So the organization, the Board of Governors there, you see there some members are appointed by the President of the United States. You see the terms there headed by the Chairman, Jerome Powell, currently. But anyway, that is the Board of Governors. We'll talk more kind of about what they do here in just a little bit. So Open Market Committee, we'll talk about open market operations here in just a little bit. Committee that oversees the buying and selling of government securities that affects the money supply. We'll see that here in just a little bit. So continuing on, Federal Reserve banks here. There's 12 district banks. You see the United States here is divided into 12 different regions or districts, I should say. And you see the one that serves the Texas area is in Dallas, but they also have 3 banks that assist that Dallas bank. You see one's in El Paso, one's San Antonio, and one's Houston. So you have your district banks are with the red dots you see on the map there in front of you. And then the banks that assist, the reserve branch banks are the ones in blue there that assist those other banks. But there are 12 district banks around the United States. Dallas Bank serves us. I just kind of mentioned that. I think this slide I pretty much mentioned there, the branch banks, and I did have mentioned that. So we'll continue on. Functions of the Fed, guys, they do a lot of things, but we're going to mainly focus on the most important one that they do is controlling the money supply. They regulate the money supply to where we don't have too much money in circulation or too little money in circulation. They will pump money in, pump money out. They'll increase the discount rate, which we know as an interest rate. They'll lower those interest rates. So we're fixing to look at that as we go through. But again, you see check clearing. They do not print the money. They do not make the money. They do hold the money. And again, they will supply that money to the banks. So we will go on. I think this is, regulating the money supply. There's 3 different ways here. And I'm going to put this up there so you guys can kind of see it as I'm talking. Whoops, and I went too far. There we go. The first one there is a reserve requirement. And you see it says amount banks must keep as cash in their vault or they're safe there on reserve at their Fed. So I always kind of refer to this as your bank savings account. They've got to keep so much of their money deposits in that bank in the Federal Reserve in their savings account to set it aside. And what the Federal Reserve can do, they can actually lower the reserve requirement or they can increase the reserve requirement. There on letter A there, you see when they lower the reserve requirement, the banks don't have to keep as much money in their reserve. The good thing is that's going to increase the money supply. Why is that? Well, we don't have to keep as much money in our savings account, so we can loan more money out for consumers to buy cars, boats, whatever it may be, houses or whatever. So it's going to increase the money supply, and in turn, that's going to encourage people to spend money, and again, get the economy flowing, things like that. If we let her be there, if we end up getting too much money in circulation, maybe a problem of inflation starts to happen, they can raise the reserve requirement. They raise the reserve requirement. Banks now have got to keep more money in their reserve, and that is less money to loan out to consumers. So your money supply is going to actually decrease. Okay, so raising that again is going to discourage borrowing. Again, banks are going to be a little tighter with the money, not allow that to money to free flow out of their banks. We saw this in the housing market crash of '09. They had to be a lot more picky on who borrowed money. You better make sure that the loans that you're loaning out to consumers are good loans and not to people who are not going to pay those loans back. So reserve requirement, again, is one way they control the money supply. They will lower the reserve requirement, or they will increase or raise the reserve requirement. Okay. Here shows you raising and lowering the reserve requirement. You'll see an example of this on your worksheet or your outline there. You see a reserve requirement of 10% there. Bank A, let's say, has $10,000. They have to keep 10% of that in their reserve. They can loan out $9,000 to Bank B. And you see Bank B has that $9,000. They can actually keep 10% of that, which is $900 in their reserve. They loan out $8,100 to Bank C. They're in the top right. Same thing there. They have to keep 10% available loan out there. You see the amount that they loan out, and then Bank D again does 10% reserve and they loan out. So you see the expansion of the money supply whenever they loan this money out. And again, you're going to see this. Be careful on your worksheet or your outline because the numbers are a little different here. It's not as much money, so be careful. Don't just copy the slide word for word. Going to the second way in which they control the money supply, we're going to look at the discount rate. Discount rate, guys, you and I know it as an interest rate. And let me see. Yeah, there we go. You and I know it as an interest rate. Feds call it the discount rate that they charge of member banks to borrow money. So hang on just a second. If we need to increase spending, we need to get the flow of money in the economy going again when the economy is struggling per se, we're going to lower that discount rate. We want to lower interest rates, kind of like in current situation we're living in the pandemic here in 2020. Interest rates are at an all-time low, especially for mortgages, things like that. And it encourages people to buy and spend money. Well, they're doing that to try to get the wheels, the gears of the economy rolling again. So they lower interest rates. In turn, it encourages people, consumers, say, hey, let's buy this. The interest rates are low. And again, it's going to increase the money supply. Same situation. We end up with too much money. The economy starts to rebound. And inflation starts to become a problem. We need to get some of that money back out of circulation. We're going to raise the discount rate. In turn, raise discount rate, and in turn, interest rates are going to go up to the consumers. And when that happens, it should discourage consumers from borrowing money. And when it discourages people from borrowing money, the decrease in the money supply is obviously going to occur. So that discount rate is passed on to you and I. You see the bottom note there to the banks and consumers, and we know that as the interest rate that we're charged through the bank. So if interest rates are really low, you know the discount rate from the Fed is really low, and vice versa on that. So that is the second way in which the money supply is controlled, is through the raising and lowering of the discount rate. Okay. Let's go on to, whoops, there's my arrows. I forgot to actually put those down there. I was afraid I was going too far. So anyway, let's go on to the open market operations. This is probably a little more confusing to understand. Let me see, make sure I don't go too far. Open market buying and selling of U.S. securities. That's a lot of times debts from bonds from banks. You see there, it's a tool that we use most often. Federal Open Market Committee, which we saw earlier in the PowerPoint. This is their jobs in regulating the money supply. Again, we use it most often. The Fed buying securities. what that does is I just try to keep it simple in terms of what I use. But the Fed wants to increase the money supply. They're going to actually buy securities and debts from those banks. When they buy that from the banks, they're actually giving the banks money. And in turn, they get debt securities from those banks. And when they get the banks get the money from the Fed for buying those securities, the banks can now loan that money out to consumers, and in turn is going to increase the money supply. Okay, situation, we get too much money flowing, the economy's really rebounded, doing really well. Well, the Fed now can say, oh, we need those securities back. We're going to sell these securities back to the banks. And in turn, the banks take the securities back, and the bank obviously has to give the Fed money back in return. And when that happens, obviously the money supply is going to shrink. Okay. So again, the buying of those securities from the banks is going to increase the money supply. And then when they sell those securities back to the banks, it's going to decrease the money supply by taking money back out of circulation. Okay. Again, that's a tool they use most often and sometimes the most difficult to kind of understand. Okay. All right, let's see where we're going. Monetary policy, guys. This is a term you'll see, basically a change in money supply to affect growth. And that is what obviously the Federal Reserve does is monetary policy. Again, to change the rate of growth, increase, decrease money supply, things like that. Sometimes we know we get in time periods kind of where loose money policy, tight money policy, and again, right now what we're seeing probably is interest rates are lower, things like that. And money's probably fairly tight because unemployment's increased. You see there, I'm on the right arrow there. Consumers are buying less. That is happening again because of uncertainty in the economy. Borrowing is probably difficult. Banks cannot afford to make poor loans at this time. If you're looking to borrow money and your credit is not very good or your character is not very good, it's probably going to be really difficult for you to borrow money. Again, consumers buy less. Businesses, they're not expanding right now. They're afraid of what's going on in the economy. So they cannot just start building and building and building when, man, we just really don't know what's going to happen. You see unemployment is high. I did see currently now we're about 6.9%. I believe I saw just the other day. And then production is reduced. And what that can lead to, it can lead to a recession. So that's, again, kind of in the business cycle we talked about the other day. That's kind of where we're at in the current business cycle. So now, loose money policy, I'm on the left arrow there now. Loose money policies when obviously things are going really well in the economy. Borrowing is going to be easy. Banks are willing to loan money because, man, things are great. Economy's flowing, people are working, and the banks know that. So consumers start to buy more. Why? Well, because unemployment's low. People are working. When people are working, they're making money. When they're making money, they're spending money. Businesses expand there. More people are employed there. Unemployment rate's going to be very low at this time. And again, people are just going to spend more money during the loose money policy. And problem is, you got to be careful here. It could lead to inflation, which means we've got too much money in circulation. When that happens, obviously we've got to do something to tighten that money policy back up a little bit. We may have to raise the discount rate. We may have to sell those securities back to the bank, things of that nature. So those are two scenarios that can happen, loose, tight money policy there in the money supply. Okay. And I think that is my last slide. So anyway, hopefully that made a little sense to you, and hopefully you followed along and were able to understand. So have a good one.